Desde Las Vegas, Nevada, iniciamos con el programa Hablando de Bienes y Raíces con Castillo y sus invitados. Comenzamos.
Good morning, Las Vegas. My name is JC Castillo. We're starting here your show, Hablando de Bienes Raíces. Today is Friday the 13th, which is a very, very interesting day. We have here two more guests. We're going to go ahead and introduce them in a little bit. But, again, I wanted to go ahead and tell everybody, thank you very much for tuning in. I will really appreciate you. You guys know we're live in YouTube. So if you like this show, give us a thumbs up. If you don't like it, also let us know why. Maybe we could go ahead and change something. So we're going to go ahead and give the introduction to the two people that we have here in studio today. We're going to go ahead and start with ladies first. So we're going to go ahead and start with Miss Jen De La Rosa. Jen, good morning. How are you?
Good morning. I'm good. How are you?
I'm doing great. Jen, if you want to go ahead and give me your name, your phone number, and what company you work for, and how long you've been in the industry, I would really appreciate it.
Sure. My name is Jen De La Rosa. I am an escrow officer at Lawyer's Title. I've been in the business for 23 years now. Long time.
Yes.
You can reach me via phone or email. My phone number is 702-693-5105. That is my direct line. And my email address is jen.delarosa, DELAROSA, @ltic.com.
Very good. And we also have in studio Mr. Barry from Greater Nevada Mortgage. How are you, sir?
Excellent. Thank you for the invite, JC. Glad to be here. But yeah, my name is Barry Teeter. I've been in the mortgage business for 23 years as well.
Wow.
And the last 3.5 of those years, I've been with Greater Nevada Credit Union, right around the corner here in the Southwest. And I love it over there.
Right.
Working there is great. Yes, sir.
Very good, very good. So let's talk about a little bit about Greater Nevada Mortgage, because I don't think a lot of people know that you guys are out there, right? Because you guys are a credit union. You guys are different than a bank. Can you tell me and explain to me the difference between a credit union and a normal either a mortgage company or a lender, because there is a difference between all three of them, right?
Oh, massive. Yes, sir.
Yeah.
Happy to. And like I mentioned, I've been in the business for 23 years,
Right.
the last 3 or so with the credit union. And so being a broker for a decade and a banker for another decade, and finally to the credit union side. In 100 different ways, it's much better for not only us, but the clients as well.
Okay.
We're nonprofit, so we're able to do things that no other bank or broker could possibly think of doing.
Perfect.
Yes, sir. Just with interest rates, we're always going to be extremely competitive and more time than not, lower than any of our competition as well.
That's good to know, because again, a lot of people never think about going to a credit union to go get a loan, but that's, very, very good loan products are out there because they're specific to your members, right?
Yes, sir. And I'm glad you brought that up. We have several options that no one else has. It's called our portfolio product. And really all that means is it's our mortgage product. We developed it, we underwrite it, and we service it. So we're never going to sell your loan. When your client closes, they're always going to be dealing with Greater Nevada Credit Union for issues, if there is any, for the life of that loan.
Right.
And they're very specific. They're not going to be a regular 5% down or an FHA, a VA. I can get into the details and on one specific loan that we have that's just absolutely the best deal possible for anyone looking to increase their portfolio and buy a home to invest and rent out.
Right.
We have a program right now. It's a 5-5 arm, so it's fixed for 5 years. Then you have a one-time rate change on month 61, and then it's fixed again for another 5 years.
Wow.
So you're not worrying about that payment going up every year after that first fixed 5 years of mortgage payments at, for example, say 6%.
Right.
It's fixed. It's never going to change for the first 60 months. And then you have one price change.
Okay.
It's dependent on the current market conditions.
Right. And that's really good to know because, you know, a lot of people right now, they're, you know, already in interest. They're already in the real estate process, right? They already own a home. They know that that's the way to create wealth. So now they're looking to say, hey, I want to buy a second home and become that, you know, rental home that you want. And this is a really good, unique product dedicated for your consumers, for your, you know, people that you guys are servicing, to give them that option and saying, hey, if you come with us, we're going to give you the best analogy of how you can move your money around without overspending money. I mean, 6% right now, I don't know if that's really what the current rate market is and if it's a 30-year loan.
It's going to be a little higher than that, yeah. So often this rate's going to be significantly lower for you as an investor, believe it or not.
Right.
And there's no points. So you're not coming in with a substantial amount of closing cost. You know, it's very low. We don't charge any points. You're simply coming in to closing with your processing and underwriting fees, and it's $1,590.
Jeez.
The only charge on these loans. So you're not having to come in. Often other banks that do these types of loans, not only is their interest rate going to be significantly higher, you're also going to have to pay the bank for the privilege of getting that very high interest rate.
Right.
So often it's 2, 3, or even 4 points, which on a $400,000 purchase, you know, 3 points is another $12,000 that you have to bring to the closing table just to get a 9% loan for an investment home. Yeah.
Right. And you know, it's very interesting because Barry's talking about points and closing costs and this and that. And Jen is like looking like, yeah, I know exactly what you're talking about, because you as an escrow officer, Jen, and maybe you could go ahead and share this with our public, is, you know, you have to understand what those fees mean, because you're the one that's preparing the settlement statement. You're the one that's going to give that consumer their final figures and say, hey, this is the total amount of money that you guys need to bring to close to your transaction.
Correct.
Can you talk a little bit about, you know, like Barry was saying, was saying, right? We have, you know, processing fee and we have underwriting fees and all of that stuff that people really never talk about because they only see it at the end of the transaction. Isn't that true?
That is very true. Yes. A lot of times buyers sometimes don't know who the fees are for. So they go in and they see the closing statement and they think all these fees are title and escrow fees.
Right.
They're not title and escrow fees. They are all of the fees associated with a transaction. So basically that closing statement you see at the end is the total amount of fees charged by everyone that was involved in the transaction, whether it be the real estate agents, the transaction coordinators, the appraiser, the inspector, the loan fees. Let's see, what other fees are there associated with title and escrow fees, of course, and your title insurance, and then your county recording fees for the recording of the deed and the transfer tax. So that closing statement is basically a final figure for the buyer to see what they are paying for the loan transaction. So it's a breakdown of all of their loan fees as well.
Right.
So it does help when your escrow officer is in there to go over the closing statement with the buyer, because it's not the loan officer going over the fees, or it's not the agent going over the fees. It's the neutral third party that should be going over the fees with the buyer and seller.
Right. And it's funny because both of you guys said and mentioned, you guys all been in the industry for 23 years. You know, I got into the industry in 98 too. So we've seen the ups and downs of the industry. Yeah. And it's funny because that document that you're describing right now, Jen, it's called the settlement statement.
Yes.
But, you know, prior 2008 or 2009, it used to be called the HUD-1.
The HUD, yep, the HUD-1
And
statement.
you guys remember the HUD-1,
Yep.
don't you, Barry?
I still often call that on accident.
Yes, I did for years after.
Right, but you know, people need to understand that it's the same document. The only difference now is that we're fully disclosing everything up front.
Correct.
So there's no surprises.
Right? Absolutely.
And I know that your company, Barry, has a very strict, you know, rules on letting the consumers know really where their money's being spent, right? How much money is going to be. Like you said, right now, you know, there's no hidden fees anymore, right?
No.
Yes, to the penny. We're going to walk our clients through at the very beginning at application, and it's really simple because it doesn't change with us. We're never going to charge any client an origination fee, which is what a broker normally would do.
Right.
So if you have a $400,000 loan, you're going to have to pay 1% origination fee, which is $4,000.
Right.
Which you'll never see that from us. So it's really simple. You have an underwriting fee of $995, and that's to pay an underwriter to do, underwrite your very difficult file. Well, they're all difficult, but it takes a lot of time. And then a $595 fee for processing. And that's basically your loan officer's assistant, and she or he is helping your loan officer that you're working with gather the documents, qualify the income, gather your assets as a team, and your credit report, which is usually between $25 and $75, and that's disclosed up front. And then your appraisal fee is the only fee. You'll see it on your closing statement, but it will be paid for at the time of the appraisal.
That's a good point, because I know Jen's shaking her head like saying yes, because everybody gets confused about that. Why is this on the settlement statement if I already pay for it, right?
Yes.
Can you explain why?
It needs to be disclosed. So it is part of the transaction. So lenders will all, basically the lender wants us to show that it has been paid. And what we do is we show it in a paid outside of closing column on our closing statement, so that the bank and everyone involved can see, yes, there was a fee for that appraisal fee, but it was paid outside of closing. So we show it on our closing statement as paid outside of closing by the buyer.
Right. And just for the people that know, or they don't know, right, when you're looking at your settlement statement, you have all your fees. You have two columns. You have the buyer side, the seller side.
Yes.
And then there's going to be a little fee on the third column with a little parenthesis that says POC, which is paid outside of escrow.
Yep.
And people usually get like really, really mad, or they don't understand, why is this fee here if I already pay for it? But it's just for us to show that everything that has been contribute to that transaction has been noted and dated, and make sure that you sign it saying, oh, I understand where all my monies has gone. Because like we talked earlier before we were coming into the studio, we went through the whole 2008 2009 mess, right?
Yes.
And we remember those good old days, if you want to call them, that there were a lot of confusion, there was a lot of misinformation, and there was not a lot of transparency. And now, even with the type of loan that you're providing, which is a 5-year ARM, everybody's like, oh my God, the ARM loans, oh my God, I don't need them anymore. That's what caused the market to crash. And I tell everybody no, because ARM loans have always existed. It's just they were misused. Now, for this particular transaction, or for this particular loan that you're talking about, Barry, for a investor, for a fact that your next 5 years, your interest rate is not going to change. Is that correct?
Absolutely. And that's the main reason the product is designed. Not only did we design it for investors specifically, but we did it based on how an investor thinks with their investors or their investments.
Right.
So they're not locked in to a loan with prepayment penalties, for example. They can get out after 5 months if they'd like, or 5 years. And they know that price change is coming, so they can look forward to their balance sheet and say, okay, after 5 years, this house will be generating this much income. So they're able to see the future, and then we give them the option on their 61st month to stay in the loan, refi it, or take the rate change, which will, inevitably be, somewhat higher.
Right.
There's a cap on that.
of course.
So it can't go higher than 8%. If you have a 6% for 5 years, there's a 2-point cap. So worst possible case scenario, regardless of what the current market's doing or the interest rates, you can feel safe that your interest rate will never be above 8%. Which is
that's good.
Yeah, but
for an investor.
Barry, right now we see interest rates of 9-10% on an investment loan, right? I mean,
Yes, sir.
why wouldn't this make sense to an investor to come in and give you a call and say, hey, can I go ahead and check to see if I, qualify for this? Hold on, let me rephrase that question. Will this type of product be something that somebody could roll into if they already have a loan? or they already have an investment home, or is it the first time purchase investment home?
No, sir. Well, you can have as many investment properties as you have. We don't care if you have 1 or 10.
Yeah.
We'll do 10 more on this product specifically. I have, a handful of clients that are on their 5th, 7th, and 8th purchase of this specific loan for a couple of reasons. The main reason is we'll give you your rental income credit, all of it. So qualifying is never an issue to buying another rental property because simply renting it out is a wash. So that new mortgage payment is not counted against you when you buy another one, because more than likely the rental income that you're receiving is going to be significantly higher today.
Yeah.
Because your interest rate is lower than anybody else out there. Even if you were an owner-occupied person with a 780 FICO score and 20% down, your interest rate's going to be significantly higher than it would be if you had a 640 FICO score, 20% down, and an investment property, which is against the grain. I mean, it's unheard of, obviously.
Right.
And that's why the product that we've developed, it's hard to say no. Once an investor hears this and gets it done the first time, they're never going anywhere else. I mean, the payment is often 40% higher with another bank.
Right. So literally, you guys created this to set the investor for success in the first 5 years, because they could have the choice to refinance the property after that and not take the higher interest rate, or they know that, their cap is going to be 2 points after the 6%, which is going to be a total of 8%. So for the next 10 years, they know exactly what their payments are going to be, and they could plan for it. Is that really?
Absolutely. And that's how we sell it, as a blended rate.
Yeah.
If you plan on keeping this for 10 years, or you grow into after 5 years, you decide, I'll keep it another 5 years. So if we have that information, we're able to say, well, your blended rate for the next 10 years is 7%. And that's lower than if you were, again, an owner occupied with a 780 or 800 FICO score.
Right.
You're not going to be able to get that rate just because that's the Fannie Mae, Freddie Mac, that's what's out there.
Yeah.
And with this program, it's a portfolio product, as I mentioned. We control the rates, the underwriting, the servicing of the loan, so we can really do whatever we need to do to get these loans closed for the client.
Right. And Jen, I mean, you've known Barry a long time. You've been in the industry for a long time. Having that investment, purchaser, right? Having that investment professional, how more convenient will it be for them to understand, hey, for the next 5 years, your interest rate is going to be 6%, which, like Barry says, is a lot lower than any FHA or conventional loans that you are currently seeing right now in the market, right?
Very true. As he's explaining this product, I'm sitting over here thinking, like, this is great. I didn't know anything about this. A lot of investors have pulled back from purchasing because there are no loan programs. They're not going to get into a 7% interest rate on an investment property right now. So I have seen a lot of investors pull back on investing right now because of the fact that the rates are too high for them. So a program like this would be great for investors to, they could pick up numerous products or numerous properties within a year with this product. So it's super good. I definitely will be telling my investors about it.
Yeah, and that's the greatest thing about, this, right? Because, we're bringing in people that are bringing us information, that's bringing us current information. Like, I've never heard about this. I mean, I've heard of the ARM loans, but not the way that you guys set it up. And this makes total sense if you are an investor and saying, hey, you know what? I don't want to pay market rate. I want to be able to understand that there is a product out there that I could come in a little bit cheaper. I might be able to either get a higher loan amount because the interest rate is lower, or I'm going to go ahead and make sure that I get the right loan amount, so like that the rental payment could cover my mortgage plus a little bit extra, so like that I have positive cash flow at the end of the year. And I know that whoever decided in your company to create this loan, they looked at all the factors and say, how can we be beneficial to that investor, right?
Absolutely.
Right.
I mean, it's the market that we're going after, obviously, with the product like this, because there's just simply, it does sound somewhat cocky, I'm sure, but there just isn't any competition rate-wise, customer service wise. I mean, the list goes on and on. What a credit union can do for their clients that no other bank could dream of.
Right.
And that's just a fact.
Right. And that's really good, again, to know, because when we hear mortgages, we, never think of credit unions. And again, I mean, the consumer doesn't, unless they are part of a credit union and they are, having conversations with their mortgage people or with their banker. They're like, hey, you know what? Our interest rate is a little bit cheaper than what's out there. They know about the product. But and if you're a regular consumer, you will never look into why a credit union, because you're like, it's not sexy enough, right?
Yeah.
We want to hear the banker. We want to hear the lender.
It's not on everyone's radar.
Yep.
Exactly. Exactly. So it's very interesting that you guys came up with that product. Now, let's talk about your experience, right? Barry, you're coming in 23 years plus. Jen, you're 3 years plus as well. We've seen the market go up and down.
Yes.
I know for a fact that based on all the data that's happening current, that we might have a slight interest reduction next week when the Fed gets together. But we know for a fact that does not affect the mortgage industry. Barry, with your years of experience, can you explain that? Because and the reason why I bring that up is because we have a lot of people that are on social media that as soon as the rate comes down, they're like, oh my God, give me a call. I could get you in the house. And they're like, no, we can't act like that because we're giving false hope to consumers. Can you talk a little bit of why that one or two does not apply to the mortgage industry?
Absolutely.
Please.
I mean, and if nothing proves your point, it just happened.
Right.
With the rate reduction twice in less than a month, just a month or two ago.
Yeah.
Rates went down for about a week and a half, a quarter of a percent or so, and then immediately skyrocketed above what they were before the Fed announced 2 rate cuts. So that absolutely proves the point that we're trying to make. So, just because the Fed drops their rate, it just doesn't have a direct correlation with lowering the mortgage interest rates. The 10-year bond is what we look at to get some sort of future idea of what rates might do. But even that, I mean, they'll tell you it's certainly nowhere near 100%, but it does give you a better indication of what the mortgage interest rates are going to do. Maybe not specific in 1/8 of a percent or, but it will tell you possibly if it's going to be going up or down. So then you can plan ahead with your clients on when we need to lock in the rate. So your payment is locked in instead of waiting for the rate to come down. Maybe we have a good idea that it's not going to come down next week. So let's go ahead and lock you in at today's rate and be safe. So with the bond market, that's what we use as mortgage.
Right. And that's really good to know because, again, not a lot of mortgage people, well, a lot of mortgage people know that, but they use that sensation of that interest rate just dropped, the Fed dropped the rate, give me a call, I could get you in a house. And Jen, we saw that for that period of time, that for a week, our refinances just spiked up, and then all of a sudden, it just went dead, didn't it?
Yes, we had I think I had about 10 to 15 refinances close within a 2-week period. And then right after that, gone. Right. Yep, nothing else. So it's like they were waiting. All these homeowners, they are waiting to refinance. They're waiting for that right moment to refinance. They have everything ready to go so that their loan officer can basically lock in that rate and go to docs immediately. So I'm seeing that happen with a lot of borrowers that are trying to refinance. They're just waiting for that moment.
Now, let's talk about the actual scenario that's happening, right? If everybody's waiting for the rates to drop down.
Yes, sir.
Everybody's praying, including all the real estate industry, realtors, loan officers, title companies,
their families.
Their families. We're all waiting for the interest rate to drop.
Yep.
But then we have that one scenario where the homeowner realizes that their other bills are way too much to cover their monthly expenses. They have enough equity to go ahead and do a cash out refinance. And then we're having that 1 or 2 refinances that are still happening even though the interest rate is not what everybody wants it to be, but it makes sense for them to say, look, I'm taking my car payment, which is at 14%. I'm taking my credit card payment, which is at 8.5%, 10%. I'm taking my student loan and bundling all together, doing a cash out refinance, and my payment with a 6 3/4 rate or 7 1/8 rate, it's probably going to be a little bit lower than having all my bills combined together. Is that something that you guys help with?
Yeah, yes, sir. And it's all of our loan officers are trained on how to manage that type of financial situation. I mean, to the T. And we have a couple of options depending on, like you said, what the interest rate is today and how that would affect them doing a complete refinance to take cash out, or we can do a second option and look at just doing a HELOC. And that's just a home equity line of credit. And it's simply a second mortgage. And we use the equity you already have in your home, and you get that check within about 2 weeks. And you just have that second monthly mortgage payment of whatever amount that you took out. For example, if your house is, you're a homeowner, your house is now currently worth $500,000. You bought it 3 years ago in the Southwest for probably $300,000.
Right.
You've been making your payments for 5 years. You're down to $275,000 that you owe. So yes, you have a massive amount of equity sitting there that you have access to at somewhere between 8% and 10%. So if you just need 50 grand, let's say, to pay off 3 or 4 credit cards of $3,000 or $5,000 each, we pay that for you at closing. We'll pay off your car, wipe the entire car payment off, and or any other payments that you have on your credit. Preferably, if you're going to go through with doing a HELOC or a full cash out refinance, we're paying it all off, which is going to give you the financial freedom to do whatever you need to do moving forward, say buy another investment property, or
And that's a great point, because that was kind of like where I was guiding you to, because there's a lot of people out there that have a lot of expenses, right? And they're like, man, I could never catch up. I could never get out of this. Well, you have an option. If you have equity, you could go ahead and, use $100,000 of your $200,000 equity. You still have equity left in your home. Clear all your debt, and then be able to purchase a investment home with the new program that you have. And now you're scaling up, right? And that's a term that's thrown around in the real estate industry a lot. You got to scale up. You got to go ahead and level up, because you have one house. Now you're going to have a rental home. Now you have, passive cash flow coming in a monthly basis. You're building equity in another home. It's a totally different mindset, isn't it, Barry?
100%. And with that investment property, the difference of buying that with another bank at 9% and buying it at 6%, it's, on a $400,000 loan amount, you're looking at almost $500 a month difference every month. So if you add that into the rental check that you're getting on the first, that's another $5,000-$6,000 a year in pure profit, all cash, just by picking the right bank.
And that's really good to know. And Jen, Barry was talking about how when they do cash out refinances or home equity line of credit, you guys have to pay sometimes, current loans, right? Current, car payments and everything.
Yes. How
easy is the process through escrow to be able to go ahead and, manage that for the consumer? Do they have to figure out, well, obviously we know what the debt is, but are we paying ourselves all those debt, or is that something that the title company handles for them?
We do handle that for them. So the lender always wants escrow to handle that for them, so that cash is not just given to the borrower. They want to make sure that they're using all that debt to pay off, or all of that cash to pay off their debt. So we will order a payoff on their auto and make sure that we're submitting the correct payment for the payoff for the auto. Credit cards, we always ask the clients to bring in their most recent statement, so that way we have all the correct information, their account number, their name, where we mail the payments to. And we do keep a close eye on those payments to make sure they do clear. A lot of times the creditors will take about up to 2 weeks to process those payments. So we try to keep a close eye on them for the client so that the client does not have to worry about it. It's all handled between the lender and escrow.
Right. And that's a great partnership, right? Having a good partnership between lender and escrow, realtor and everybody, because everybody's on the same page, because what we want to do is literally provide the best service for our consumer, for our client, right? Because they're the ones that, don't have to be running around. And I could assume, and correct me if I'm wrong, that there's a reason why they don't give the money to the consumer.
Yes.
Right?
Yes.
There's a reason why they have to have title and escrow make those payments. Unlike, hey, here's an $80,000 check. I hope you pay your bills. Because we've seen that happen before, right?
We get asked all the time, can you just write that check to me?
No.
Right. And there's a reason why the lender is saying no, because we want to make sure that debt, it's cleared.
We want them to be or the lender wants them to be in a better financial position,
right?
Which is the reason why they want all of that debt paid off in order to give them the new loan.
Right. And it's very interesting because, again, a lot of people don't understand that, Barry. They're like, it's my money, I should get it. But it's like, no, we want to make sure that you guys are financially stable after this,
100%.
Yep.
I mean, and we're depending on those being paid off 100% because that's how we qualified the person to even get the loan in the first place. So that goes to how important it is to have a title company like Jennifer works for, and working with her for 20 plus years. I mean, the security that gives me with my clients shows. They feel my confidence in her, and anyone who's bought a house absolutely knows the importance of the title company,
right?
And the professionalism of closing that loan on time, which is the most important thing for everybody. That those 3 letters, COE, which you will hear the last 2 weeks of your loan closing all the time, is close of escrow. And working with Jennifer De La Rosa at Lawyers Title now for 2 decades, it gives you all the security we need as loan officers to pass that along to our clients.
Right.
It's a great feeling for sure.
And that's great. And, right now that you're talking about, canceling debt, right? We're having the lender saying, hey, here's $85,254.66 to pay off all the debt, because that's all the bills that Jen said, hey, this is what we need to collect to pay that off. There is a very important word out there that nobody speaks about it, but it creates a lot of headaches at the end, which is a reconveyance.
Yes.
Can you give me your expertise on why a reconveyance is so important to follow through, Jen, please?
Yes, a reconveyance is super important to follow through on. What happens is once your loan is paid off, a reconveyance is recorded on your property, which wipes out the deed of trust that was just paid off. So a lot of times, if you have let's say a hard money second on your property or any type of private loan, it's very important to make sure that the title company is properly preparing the reconveyance and recording the reconveyance to remove that old debt. What happens is a borrower or a homeowner will have a deed of trust on their property, and let's say it was paid off 10 years ago, and then they go to refinance and that old mortgage is still on their property. It is very important for us as the title company to make sure we get that old mortgage removed from the property so that it does not show on the client's title.
Yeah.
So it's definitely super important to make sure your mortgages, once they're paid off, are reconveyed. One good tip is for people that are homeowners in Clark County, you can go to the Clark County Recorder's website and you can register your property to where you get an email or a text notification anytime something is recorded on your property. And I strongly advise all homeowners to do that because it just helps you with all the fraud that's going on now and the reconveyances as well. It just gives you a clear mind to know that nothing is being recorded fraudulently on your property, to make sure that the reconveyances, let's say you just refinanced, you will get an email notifying you that reconveyance has been recorded on your property. So I strongly advise.
And
them to go do that.
And that's a great tip, Jen, because you and I had a transaction or a phone call, very, very, very unique, but very unique, but it happens all the time where somebody had a private Benny, they paid off their loan, and then they called and they're like, hey, where do I get my title?
Yes.
And I'm like, I'm sorry, but this is not like, it doesn't work like when you pay off a car loan, right? You get the title of the car.
People always think that.
Right.
Yes.
And we have to go through that explanation. Can you please share that and explain to people that when you pay off your mortgage, you don't get the title?
No, you do not get a title. You don't get a pink slip. You don't get anything.
Yes. Right.
Yes. What you get is right after you purchase a property, we are going to send you, as the escrow officer, I'm going to send you your closing package, which consists of your final closing statement, a refund check, and the original signed deed from the seller. That is your recorded deed on the property that you always want to save. But your title is basically your title insurance policy that comes about 6 weeks after closing. That is showing you that you have title insurance on your transaction. If there is ever an issue that may arise in the future over your property's boundaries or any old liens on the property, that is what your title insurance is there for, that title policy to protect you and your property.
So again, you don't get a pink slip, you don't get anything saying, hey, you know what? I remember when my father finished paying off his mortgage, he was really upset.
Yeah.
And he called me, he's like, you know what? I've sent my last payment, and man, I didn't even get a thank you from like mortgage. I'm like, are you kidding me? I go, that's how they make their money. They're actually, when you pay off your mortgage, they're really upset because they're losing money. They're not collecting any more fees off of you and everything. So, it's a great thing, but also they don't understand the process of, hey, you paid off your mortgage. What are you expecting? A celebration or something like that?
Yep.
It doesn't happen from the mortgage side. And Barry, in your 23 years of, being in the mortgage industry, when somebody pays off their home, right? And then they call you and say, hey, I finished paying off my mortgage. I want to go ahead and start looking to see if I could purchase another one, or I could do a refinance and everything. I don't know if you guys know this, but here in the Clark County, we have over 140,000 homes that are fully paid for.
Wow.
No mortgages. Imagine the amount of, equity people are sitting there.
I know who to call when I leave here today now.
But you know what I mean, right? My question is going to be for Barry is, Barry, those people that are sitting in this equity, how come or why are they not tapping into that, wealth that they have sitting there and trying to purchase another property? Or it doesn't have to be a single family. It could be a small little condo. It could, something else that's going to help them generate more wealth, right?
Absolutely. Yeah. And we'll even do a manufactured home on this.
Okay.
We'll do a 1 to 4 unit. We're open to all types of properties. We love them, and we'd love to see people that are in that financial situation of owning their own house is amazing accomplishment, obviously. So there's a couple of options. First off, is if they're comfortable,
right?
With not fully having 100% ownership of their home, because if they need the cash to buy a couple of houses, for example, we're going to need to do a cash out refi, or I can do a first lien HELOC, which is just a little bit cheaper, less closing cost. And so to get that cash that they need, because we're going to need the 20% down payment on anything that they're looking at. So if they're looking at a $500,000 rental property, they're going to need to take out at least $100,000 in equity, which we can do in a couple of weeks. Take that money, which is great because then we know where the money came from. So they don't have to try and explain that to another lender. Oh, I have $100,000 here, and go through all of that. We did the loan. They have the money. Let's do another one. Or 10, whatever they're comfortable with.
Right.
If they're successful with one, the second one's coming quick. I promise you. As soon as they're making some money after a few months and they have a good tenant and they're comfortable with that tenant, I promise you, they're calling me again to do it again because of the rental market being what it is today. It's significantly higher than any mortgage payment you're going to have right now, 100%.
Yes. And we were talking about this prior to, because I told you guys, I had a real estate agent a couple of shows ago that we talked about rental control, right? And I remember during the election period, we had our local, our local politicians saying, "Oh, we should have some kind of rental control, and this should be a thing that we're gonna do when we're gonna push through legislation." And then I started talking to this agent that he's like, "Dude, rental control is not the answer." Right, because it limits a lot of, and it could really hurt the real estate market right now. And the way that he explained it is, right now by people not selling their homes because they're holding on to that very low interest rate. Mm-hmm. It's kind of like we have a cap on our rental control because now there's not that many homes that are being purchased to rent. So it raises the amount of households that are rentals right now. And Jen, you were saying, I mean, we've seen rentals of $1,950 a month, right, Jen?
Yep, more than a mortgage right now.
Yeah. So, again, right, we have to be able to identify the consumer that think they might be able to purchase, right? Mm-hmm. We got to identify the consumer that might have some equity in their property, and now they're looking at with this option of saying, hey, I could purchase an investment home, very cheap money. I don't have to do a lot of, money into the process, and then like Barry says, once they get the taste of one, then the second one is coming really quick, and then they start building their portfolio. Isn't that right, Barry?
Yes, sir. You've absolutely explained that perfectly. Mm-hmm. At first, second, and hopefully as many as 10.
Right.
And then, as you guys have seen as well, just the market has exploded, especially on the west side. Mm-hmm. And in the last 2-3 years, between the equity that they've gained just by the market doing what it's doing, mm-hmm. and having it rented out, making money that way, the sweat equity, and then the monthly cash flow, mm-hmm. you've got them both. And often you're only getting one of those two benefits as an investor, mm-hmm. in the past, because you're either high interest rate, the rental market is low, mm-hmm. so you're having to cover the difference of your mortgage payment. And that's just not the case today. Mm-hmm. So it's much easier to sell to the average Joe, mm-hmm. or Jane, hey, you can do this. If you're a regular W-2 employee making $60,000 a year, mm-hmm. if you can come up with 20% down payment, mm-hmm. we can get you qualified.
Right.
Because your rent is going to offset your new mortgage payment, as we discussed. So, mm-hmm. we try and make it as simple and easy as possible to get that taste, mm-hmm. of financial freedom.
Right.
That in any other circumstance, it's very difficult. If you are a W-2 employee, you're locked into $50,000-$60,000 a year, mm-hmm. with no bonus structure, mm-hmm. no ability or time to have a second job, mm-hmm. or any gig, to make the extra cash to get ahead. Mm-hmm. Why not let the market make you money? Right. You take the financial risk, save a little money. Mm-hmm. Give it a try.
Yeah. And you know what? You said, financial risk. You said, save money. It is discipline. You have to have discipline to be able to save money, right? And sometimes, going to Starbucks 2-3 times a week, it adds up. Going to Target 2-3 times a week, it adds up. Yep. I mean, when we grew up, right? 20 years ago, you had a cell phone that all it did was make phone calls for you. Now, we know for a fact, because there's consumer data out there, that the average household has 4 to 5 cell phone lines with 4 to 5 payments on those cell phones that are an average of $1,000 each. So, the expenses has definitely got out of hand. So in order for you to be financial, wealthy, you have to have discipline on your expenses, because I know people, and Barry, correct me if I'm wrong, that make $450,000 a year and they spend $600,000 a year.
Yeah.
And I know people that make $60,000 a year and they only spend the bare minimum and they could purchase whatever they choose to, right?
Isn't that amazing? And I do see that, mm-hmm. every single day. Mm-hmm. As we were talking about earlier, a regular Jane, mm-hmm. made $57,000 last year and $54,000 the year before that. Mm-hmm. And in the last 16 months, we've done 7 investment purchase properties for her.
Wow.
All on the west side.
Right.
And in 16 months, any realtor can tell you what the market has done. Mm-hmm. So the equity alone is over $1 million.
Yeah.
So imagine if you made $60,000 a year. Mm-hmm. Try and just think for a second, how long is it going to take you to save $1 million?
Yeah.
It's absolutely, positively impossible.
It is.
Well, we are in Vegas, so maybe megabucks, but that's the only way.
Yes.
And with what the real estate market is doing, don't just listen to me. I'm the mortgage guy, but talk to any realtor. You have a friend that has a realtor friend or that is a realtor, get a second, third, fourth opinion. And I'm telling you, 100% it's going to be very similar.
And I think it's fear. I really think that fear is what holds a lot of people back. And so, but meeting with somebody like Barry that knows what he's talking about, knows what he's doing, and can help them to create their portfolio to get started on. A lot of us in our generation, we're now thinking about, oh crap, retirement's right around the corner. What are we going to do? So that is a good way to start building for your retirement by, building your portfolio on your rental properties.
Yes. And you know what? Jen, you just gave me the actual perfect segue to what I was going to talk about next, which, I was telling you guys earlier, I was listening to a podcast where they were talking about the boomer generation. As sad as it sounds, they're going to disappear within the next 25 years.
Yeah.
Right? The boomer generation, they're going to disappear. Then it's our generation taking over.
Yeah.
And everybody says, oh, you know what? They're very wealthy, savvy. They have their houses paid off and everything. But, the average inheritance that comes from a baby boomer, it's close to between $80,000 to $100,000. And we know for a fact right now that $100,000 doesn't even put a dent.
It's like 10,000 right now.
Yes.
100 is like 10.
Yes, right? It doesn't even put a dent on a lot of the debt that's out there. I mean, we talked about it, we're seeing, and correct me if I'm wrong, Barry, I think you see it more often than us. People are buying, $60,000, $70,000 trucks and $60,000, $70,000 cars where the car payment is $1,000, $1,200, $1,500. $100,000, you could eat it up in a heartbeat. Isn't that true, Barry?
Oh, and you just hit the nail, because nothing will kill your future mortgage purchase faster than a fat car payment. $500 or more.
Yeah.
Really, it screws up your debt to income ratios that you just can't recover from if you have an $1,100 Mercedes payment every month for the next 8 years, which is crazy. They're extending them as long as 10 years at BMW. It's just wild.
Yeah.
So if you can avoid those big car payments, because that's the number one reason that is going to keep you from financial freedom, 100%, unless you've got, a massive credit card, build up of debt. But that car payment is there for the next 7 years, and I see it, and that's going to, affect how the underwriter is going to approve or kill your
because
loan.
of a car payment.
Yeah, and let's be honest. You know what? You're making that $900,000, $1,000 car payments, and your car is sitting 8 hours a day because you're literally working, sweating
to buy that
to pay that, right? So again, financial freedom is disciplined, is knowing when to buy, what to buy, and what not to buy. That's the biggest thing, because we all need a car. But do we really need a $1,000 payment car?
Absolutely. If you have to have that car, do what the example we just gave, where Jane has bought 7 properties. If you can wait 16 months and buy 16 properties, you can buy 10 cars for cash and never have a car payment. So let's just put the brakes on. If you have to have that car, come see me and wait a year, okay? Just wait a year and we'll buy you 2 of them. You can buy one for your mom and your dad and yourself with cash if you have to do it.
Right.
I would prefer you take that cash and buy another property. So in 3 years, you've got triple.
Right.
Or whatever the market's doing for your equity at that time. But it's much more positive if you can buy a house, and it's much more rewarding. I promise you, if you buy an investment property, you're going to love that much more than any car you can ever buy. I promise you.
And that's really good tip, because again, we see it all the time, Jen. You hand out, refinance checks and everything, and I've heard it when I'm doing the signings, and I'm pretty sure you hear it's like, great, now we're gonna go on vacation. You're like, oh.
Yes, all the time.
Right.
The first thing they say.
But that's like how American society is. I mean, that's how Americans are. We overspend, and I have a lot of repeat customers that they refinance every 3 years because they know that equity is building up. They rack up their credit cards. They want to pay off their new car that they just bought. And so it's a constant every 3-year thing where we get ourselves stuck in this situation based on how expensive everything is, and we rack up those credit cards. And in another 3 years, we need to pull out our equity to make sure we get all of our debt paid off. And
Right.
so it's a cycle.
It is a cycle.
It is.
Now let's talk something about let's talk about the elephant in the room. A lot of people say that we are in a bubble, that the real estate industry is going to crash. I mean, all three of us have seen the bubble burst and crash.
Yep.
Yes,
I
sir.
personally think it's not going to happen. What is your take on that, Barry, Jan?
Yeah, I agree. Without being political at all, everybody knows the changes of what is going to happen between the two candidates. So we have an idea of what he's going to do, which will reflect how everybody in the financial industry, reacts. And they control the rates.
Right.
Yep.
And, if they lower the rates, then we'll follow suit. But if they don't, we'll, tackle that issue as well.
Right.
And move forward. So,
Right. And the reason why I bring that up is because we know for a fact that right now, the real estate transactions are pretty slow. I mean, Jen, you felt the slow. And I usually tell this. I usually tell my escrow officers, we entitle an escrow, we have the pulse in the market because we see, 3 openings in a week. And then all of a sudden we see, an opening every other day. And then we see 2-3 openings per day. And then we see the market really start picking up. And then all of a sudden we see that when the volume turns down, then all of a sudden it goes the other way, right? We know for a fact that if the interest rate drops, that's going to create a bunch of people wanting to buy. And that's going to create a frenzy where people are going to do highest and best, cash in, and all of that stuff, right?
It has to happen. It has to, those rates have to come down so that people can continue living. And like I said before, it's a cycle. All of these people are sitting on their equity right now, and they need to get their equity out of their property to live again. So I don't see a bubble. I don't see a recession again as far as how bad it was before.
Right.
I don't see that, but it's hard to tell because it is up and down. It's up and down, and it's been up and down for the last 2 years. So it's just writing it out and waiting to see what happens.
Right. Now, with that being said, for the people that are listening to us, and I know the investors are definitely, hopefully they're going to call you and be like, hey, I want to get more information about that. But for the regular consumer, the Joe and, the Joe and Jane that are there and say, you know what? Should I purchase this time? Should I buy now? I say yes. Jump into the market now because we still have, fairly, interest rates that are a little bit high to what we were used to. But to me, it's in a normal interest rate. The prices of the homes right now, especially during this Christmas season, we're seeing 20-30% price reductions, and sellers giving contributions. Right?
Huge price reductions right now.
buyer's market.
Yeah. So I think right now is the perfect time to purchase, or at least to call Barry and say, hey, you know what? I'm not an investor, but I want to see if I could purchase. Do you recommend for people to start making that type of decision for 2025?
100%.
Yeah.
I have always said from day one, the second you qualify to purchase a house, you do it. If you can qualify, don't even look at the interest rate because it doesn't matter. You got to get into the game. You can always refinance. In a year or 2 or 3 years, you refinance when the rates are low. You already own your house, so you have those 3 years of equity. So if you can qualify, if you can find a reason not to do it, I want to hear it. Because
that's a good one.
Yeah.
it's just, it doesn't exist.
It doesn't.
Right, Jen?
I agree. You're going to, everyone needs somewhere to live, right?
Yes.
So you're going to either give your apartment complex all that money, or you're going to put it right back into your own equity in the home that you own.
Right.
So, and right now, with how high rent is versus mortgages, you're better off getting yourself into a mortgage right now versus rent because, your rental's going to go up every year. And you're just throwing money away.
Right.
So.
Definitely. Well, I told you the moment was going to come.
Sir.
It is 11:10 already.
Wow.
Time flew by, didn't it?
Yes, it did.
I told you guys. So I really appreciate you guys both taking the
you.
time to come
Thank
down
you.
here.
Thank you for having us.
No, definitely. Your expertise
great
and your
pleasure.
professionalism is definitely well expected out there. So again, if you want to go ahead and give me Barry again, sorry, your name, last name, company you work for, contact, and then one last quick tip to our consumer, I would really appreciate that.
Yes, sir. All right. Well, again, thanks for the invite. I had a great time and sincerely look forward to doing it again as soon as possible.
Perfect.
Again, I'm Barry Teeter, and I am currently with Greater Nevada Credit Union right here in the Southwest, right off of the 215 in Durango. We have a great office, so you're welcome to come in and see us and take an application in person if you prefer that. Of course, we can do them online as well. And you can reach me several ways. Direct anytime on my cell, and that's 702-858-LOAN, LOAN 5626. That's 702-858-5626, or LOAN, if you can remember that. And then email as well is BTEETER at gmns.com. And that's just my first letter of my first name, Barry, B, and then my last name, Teeter, spelled out at gnms.com. And that's Greater Nevada Mortgage Services.
Perfect.
And you can get me anytime. Happy to help.
Perfect.
Thank you.
Jen, again, if you could give me your contact info, please.
Sure. My phone number is 702-693-5105. That is my direct line. You will get either myself or my assistant, Debbie Martin. We are always available to help. My email address is Jen, JENN .Delarosa, DELAROSA @LTIC.com.
Perfect. I really appreciate you guys both. And my name is JC Castillo. You could go ahead and contact me outside of the air at 702-416-4302, 702-416-4302. Again, we really appreciate you guys. Go ahead and, viewing. If you like the show, give us a thumbs up. If you don't like the show, let us know why, and we could definitely adapt and change for you guys. And like I always tell, remember, you as the seller, the buyer, you guys could choose your own title company. So do not let your realtor or your loan officer choose the title company for you. We're here to help you, lawyers title, like always. And I hope you guys have a great weekend. Please behave, because it doesn't cost anything to behave well, and take care of each other. And we'll see each other next week. All right. So have a wonderful time.